Hey everyone, welcome back to Corporate Decoder, the place where we take the lid off corporate filings and see what is really cooking under the hood. Today we have Hovnanian Enterprises Incorporated's latest report, and let's just say, it seems like they're trying to put on a brave face while also giving us a peek behind the curtain on some potentially tricky numbers. Before we dive in, if you like getting these kinds of straightforward breakdowns of complex financial documents, do yourself a favor and hit that subscribe button. And hey, we've got a great community over on our Discord server, linked in the description below, where you can chat with us and other viewers about these filings. Come join the conversation. Now, this is what is considered a current report Form 8, meaning it is about a significant event that has happened recently. In this case, on the 4th of December, 2025, Hovnanian Enterprises Incorporated, or Hovnanian as we'll call them, announced some preliminary financial results for their last fiscal quarter and the whole year. Think of this as a company giving us an early heads up on how they think they did before the full feast of numbers comes out. Before we get into the numbers, let's quickly touch on what is registered here. Hovnanian has its class of common stock trading under the ticker HOV on the New York Stock Exchange, and also some depository shares for their preferred stock, ticker HOVNP, on the Nasdaq Stock Market LLC. This tells us they are a publicly traded company with shares available for anyone to buy or sell on major stock exchanges. This section is where the main event is. Hovnanian is telling us they issued a press release talking about their financial results. Now, the big caveat here is that what is being filed is just the announcement of these results, and doesn't count as officially filed in the same way as a full financial report. This is a crucial distinction because it means the company is providing information, but with fewer legal penalties if something is slightly off. Here is where it gets interesting. The company is clearly highlighting that they're using what are called non-GAAP financial measures. Now, what does that mean? GAAP, or Generally Accepted Accounting Principles, is like the official rulebook for how companies report their finances. Non-GAAP measures are figures that a company calculates outside of these official rules. They often do this to try and present a picture of their performance that they believe is more favorable or easier to understand, often by excluding certain expenses or gains. The company is telling us up front they are using these, and it is smart for us to pay close attention to them. They list several of these non-GAAP measures like adjusted EBITDA, home building gross margin before certain costs, and adjusted income. Management believes these measures are useful because they try to show the company's performance without the impact of various items they feel aren't characteristic of their ongoing operations. For example, they mention excluding interest expenses, land charges, and gains or losses from debt. Now, while these can be helpful for understanding a company's core business, it's important to remember they are not the full officially sanctioned picture. They can sometimes smooth out the rough edges of financial performance. They also explicitly state that their calculations of these non-GAAP measures might be different from other companies. So comparability can definitely be an issue. Always look at the real GAAP numbers alongside these. And here, the filing points to Exhibit 99.1 for the full details and reconciliations. This Exhibit 99.1 is the actual press release that lays out the preliminary financial results. This is where the juicy details live. We don't have the full table here, but the text mentions a few key things that we can infer from the context of an earnings release. They're reporting on their fiscal fourth quarter and the entire fiscal year that ended on the 31st of October 2025. While we don't see the numbers directly in this 8K filing, an earnings press release typically contains the most crucial financial highlights that management wants the market to see. This often includes revenue figures, earnings per S-hair, and key performance indicators related to their core business. For Hovnanian, a home builder, this would likely include things like new home deliveries, backlog value, average selling prices, and their gross profit margins. They mentioned adjusted EBITDA, which is a measure of profitability before interest, taxes, depreciation, and amortization, and often adjusted for one-time items. They also talk about home building gross margin, excluding certain costs. These are the types of numbers that investors and analysts will pore over to gauge how well the company is performing. And finally, we have the signatures. This is the formal part where an authorized officer of the company, in this case Brad G. O'Connor, the chief financial officer, signs off, confirming that to the best of his knowledge, the information in this report is accurate. This is standard procedure for SEC filings. Now, let's put on our investor hats and think about what this filing really tells us. Hovnanian Enterprises is primarily a home builder. Their business is cyclical and heavily influenced by interest rates, the economy, and consumer confidence. The fact that they are releasing preliminary results and emphasizing non GAAP measures suggest a few things. First, they want to get their messaging out quickly, perhaps because there is news they want to manage market expectations around. Second, the focus on non-GAAP measures, while common, can be a way for management to highlight what they see as the underlying strength of their business. Potentially by downplaying the impact of expenses like land costs or financing charges that can fluctuate significantly in the home building industry. From a strategic perspective, home builders are always trying to balance growth with profitability. They need to acquire land, build homes, and sell them all while managing costs and market demands. If interest rates are high, as they have been in recent times, it makes it harder for buyers to afford a mortgage, which can slow down sales and put pressure on pricing. It also increases the cost of borrowing for the builder itself. So when we see a home builder talk about adjusted margins and EBITDA, it's a signal that they are trying to demonstrate resilience and profitability in potentially challenging market conditions by stripping away some of the costs that are inherent to the home building and financing cycle. The mention of land charges and loss gain on extinguishment of debt in their non-GAAP explanations is also quite telling. Land is a significant asset for a home builder, and its value can move up and down. If the market softens or if they bought land at a high price, they might have to take write-downs, which are essentially accounting losses that reduce reported profit. Similarly, if they've refinanced their debt, there can be costs or gains associated with that. By adjusting for these, they are trying to show a more consistent view of their operational performance. Looking at this filing, my impression is that Hovnanian is navigating a complex economic landscape. The emphasis on non-GAAP measures means we have to do a bit more digging to understand the true financial health. Are these adjustments truly reflecting a core sustainable performance, or are they masking underlying issues related to land assets or debt management? Without seeing the actual numbers in Exhibit 99.1, it is hard to give a definitive verdict on their performance. However, the strategy of focusing on adjusted figures often indicates management's desire to present a more stable and positive financial picture to investors, especially in an industry known for its volatility. The key risks for Hovnanian, as for any home builder, will continue to be interest rate fluctuations, material and labor costs, and the overall economic outlook affecting housing demand. Opportunities will arise from potential improvements in the economy, favorable demographic trends, and their ability to manage their land inventory and construction efficiently. Alright, that is our quick decode of this Hovnanian Enterprises filing. What is your take on companies using these non-GAAP measures? Do you find them helpful or confusing? Let us know in the comments below. If this breakdown helped you understand the filing better, please give this video a thumbs up and subscribe for more corporate insights delivered straight to you. Don't forget to check out our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.